and welcome to the 2022 Tax Season Preparation Tips webinar. On behalf of our president, Ron Busby, our board chambers, and our staff, thank you for attending. I'm Tiffany Meza-Hellor, Outreach Specialist with the U.S. Black Chambers Incorporated, affectionately known as the National Voice of Black Businesses. We represent over 140 Black chambers of commerce and small businesses across the nation and are founded on 5 pillars of service: advocacy, access to capital, contracting, entrepreneurial training, and chamber development. This webinar was crafted in collaboration with our chambers of commerce, providing technical assistance and resources to businesses across the U.S. with the U.S. Small Business Administration, SBA, Community Navigator Pilot Program. Thank you for your assistance in developing and sharing this program. Our team at USBC, as well as our 20 Navigator chambers, look forward to being a resource to you and your business as you navigate through this journey. Before we introduce today's guest, I encourage you to drop your questions into the chat and we will address as many as possible at the end of today's webinar. Today, we welcome our special guest, Catrina Craft. Catrina is a CPA and business financial advisor with over 20 years of experience in accounting, tax, and business strategy. Catrina has been a part of several startup companies as well as Fortune 500 companies. This wide range of experience and given her a deep understanding of how businesses operate, which she now utilizes as a financial advisor to help small businesses grow. With tax season upon us, it's important to ensure that your company is best positioned to take advantage of changes in the tax law and available credits to help reduce your tax exposure. So today, Catrina will cover 4 areas while you can think when you're preparing your 2022 taxes. Number 1, often overlooked business tax deductions. Number 2, new guidelines related to receiving and sending 1099 non-employee compensation. And 3, today, let's discover if you may be eligible for a tax credit of $26,000 per employee. Catrina, it is an honor and pleasure to have you here today.
Thank you, Tiffany. I am so happy that you have joined me today to really talk about tax season preparation tips. How many people love tax season? I just want to know. Well, I do, because it's a time for me to really help my clients utilize the tax code to build wealth. So today we're going to talk about some of the things we can do to help you with taxes. I want to first give a disclaimer that this information is contained within this webinar is provided for informational purpose only. It's not intended to substitute for obtaining accounting and tax advice from your financial advisor. Remember, the tax laws change all the time. They're very fluid, and your situation may be different from your neighbors or another business owner. So please seek professional guidance. Are you satisfied with the taxes you pay? How many of you all can raise your hand or put Y in the chat if you are happy with what you pay? Are you confident you're taking every advantage of available breaks? You probably hear that the rich pay less taxes, like Warren Buffett says he pays very little taxes. Well, it's because he has the guidance that's needed to take advantage of the tax breaks. Really, the tax code was developed to help business owners. So small business owners, medium-sized business owners, large business owners. The code is for you. It's for you to utilize, because as business owners, we really help the economy. We help the economy by employing workers. We help by selling goods and services. And so the tax code is really set up to your advantage. So let's make sure you understand how to utilize the tax code. Chief Justice William Rehnquist, he has said there is nothing wrong with a strategy to avoid the payment of taxes. He was a Supreme Court justice, and he has said that. So if he said that, please don't be afraid to use the code to your benefit. Welcome. I'm Catrina Craft, as Tiffany mentioned, and I do assist individuals with tax savings plans. What I want to make sure you understand The tax code is for business owners. So if you are individual and you don't have businesses or real estate, it is very difficult for me to help you with a plan. I mostly will assist business owners improve their revenue, improve their profitability, better manage their cash, and use tax strategies to grow wealth. That is my sweet spot because I know how to use the code to help you build wealth. So I am an entrepreneur. I enjoy working with small businesses. I am a small business. I have a certified public accounting firm. And I also started a company, Craft Entertainment CFO, in 2016 because I started working with a lot of people in the entertainment industry, and I saw a need for business management in that area. So today we are going to talk about tax season preparation tips, and we're going to talk about the overlooked deductions. Are you required to send a Form 1099 to contractors and business owners? And should you expect to receive one? And are you eligible for a $26,000 per employee tax credit? That is money that is out there that only 40% of business owners have applied for. And you have until 2024 and 2025 to still go back and claim that credit. So it's not too late. So why tax planning? Tax planning really means looking forward to minimize your tax, not just recording history. So if you come to me now and you say, I have a box of receipts and I want you to do my taxes, it's really too late. You really need to start before it's time to record your information. And that means planning, looking at those deductions that you can take before year end. So right now it's time to plan for 2023. Because 2022 is really over. 2023 is now the time to meet with your advisor and plan to see how you can take advantage. So today, let's look at how can you take advantage of business tax deductions. So the IRS says that anything that is ordinary and necessary that's a business expense is a deduction. So ordinary and necessary. So I may say that in my business, it's ordinary for me to go to dinners and meet with clients and to take trips to conferences. But in your business, that may not be ordinary and necessary. So there is a fine line when the IRS decides if something can be taken as a deduction. Ordinary means it's common and acceptable in your trade and business. I have clients, as I mentioned, that are entertainers. So when they're buying wardrobes for different events that they never wear again, it's just basically considered a uniform, or they on set and they have to have different makeup and wigs and outfits. That is ordinary in their business and it's necessary. Necessary means it's helpful and appropriate for your trade of business. So it really depends on the facts and circumstances. But if I try to deduct my clothes that I wear on the street, the IRS would say that is not ordinary and necessary as a CPA. So we're going to talk about that. And that's why I really feel like you need to find an advisor, CPA, tax preparer that knows your industry. They need to know what is ordinary and necessary in your business. I don't work with all types of industries because I want to make sure I understand your business so that I can help you grow and help you take those deductions. So that's one of the first things I would say. Please look for someone that knows your industry and they know the code related to what's ordinary and necessary in your field. Let's talk about meals. Meals limited to 50% of total expenses in 2023. In 2021 and 2022, the IRS knew that because of COVID, a lot of restaurants were really suffering. And the IRS allowed you to deduct 100% of your meals if they come from a restaurant or if you eat at the restaurant. So the difference is if you are traveling and you stop in a convenience store and you get a sandwich, it would not be 100% because it is not a restaurant where you're sitting down or have the capability to sit down. Now, if you're at a hotel and you order takeout in the room, it is a deduction. And if you order catering and it's from a restaurant and they bring it to you, it's still 100% deduction. That's in 2021 and 2022. So if you have not prepared your 2022 taxes and you have meals, please look at those receipts because you may just be eligible for that 100% deduction. Meals provided to certain employees for the convenience of your employer is 50%. So let's give the example of if you have workers and they cannot leave premises because say if they're doctors and they don't get a lunch break, they have to be there, or they're factory workers or something where they cannot leave and it's for the convenience of the employer, that's a 50% deduction. So that may be a way to really incentivize employees. That's a benefit to them because you can then write off 50% of their meals and you can provide those meals. So you are allowed to do that with certain employees. Office parties remain 100% deductible. So that doesn't mean you can have a party every day and take 100%. So there is a limit. So if you want to have holiday parties or special, anniversary parties for your company, those would be 100% deductible. And that would include the venues, the meals, the drinks, the entertainment. So 100% deductible when it's office parties. And that means your employees are there and your customers can be there and your vendors. So you need to make sure that you're not just having an office party and inviting your family. So I've had some people write off a wedding or attempt to write off a wedding, but they didn't invite any business people. It was just their family, and their family, they were in the type of business where their family are not their customers. So make sure you understand the rules. So many employees are struggling to hire and retain employees during the great resignation that's happening. A lot of people are resigning and it's really hard to find people. So as I mentioned, one thing that you can tell potential workers is that tax-free fringe benefits of really paying for meals. That could be a benefit that some employees really appreciate. So common examples of other tax-free benefits are health insurance and paid vacation. So you're probably aware of those. But the fringe benefit of the free meals, usually lunch, it can make your employees very happy with that. That deduction is scheduled to end in 2026. So it's a perk you want to give your employees. Make sure you understand. That's why it's so important to keep up with the code. And it's not your job. It's your advisor's job because things are time sensitive as well. So if I give this presentation today, the law could change tomorrow. So that's why it's very important to keep abreast of these tax deductions. Additionally, meals. Not all meals are tax-free benefits. So we want to make sure that you understand that. So no cash alternative for not taking the meal. So say, for instance, someone says, I don't want a meal, just give me the cash. You can't deduct that. So if it's for the convenience of the employer, again, you can take that deduction for meals. Now, I have clients that maybe once a month, they may bring in catering and they just cater for the whole office. That is a deduction. And remember, we talked about for 2022, if you did that and you brought in catering from a restaurant, that was 100% deduction for you. So make sure you understand the timelines on when you could do that. If you did do a lot of meals, had a lot of meals in 2021, you can look to see if you can amend your tax return. It may be worth it. It just depends on how many meals that you really had. And if you didn't take that 100% deduction and you thought it was 50, you can go back 3 years and amend your tax return. Now, with meals coming in, the IRS has really looked at meal services such as Grubhub and DoorDash and Uber Eats, and they may say, well, for your convenience, is it really for your convenience when we have services like Grubhub, DoorDash, and Uber Eats that can deliver meals? So you really need to document what you're doing when you're providing those tax-free meals to employees, and make sure you pass those tests and guidelines. Not sure if you're aware, but entertainment is no longer deductible. So the IRS does not allow any business owners to deduct sporting event tickets, plays, deep sea fishing, concerts, all of those good things that help develop your business relationships. Golfing, the IRS no longer allows that. But what I say is, if you are doing a sporting event, if it is you have the ability to go to a meal before the event, then that meal is deductible. You just need to make sure you talk about business before, during, or after the event. And you need to make sure that it is some type of business relationship that you have with the person that you are taking. Now, if you get a suite and it has food in that suite, there is a way to deduct a piece of that expense that is related to the meals that are in the suite. So there are different ways that you can look at maybe turning a deduction that is gone into now 100% deduction. So we could look at the meals. We could look at sometimes when you get a suite, that's advertising. You may have your name on the suite door, or they may flash your name doing the game, half times, or on the screen. So then that's advertising, and that is 100% deduction. So I know that a lot of the arenas are adjusting how they qualify certain expenses and contracts, and they may put more toward marketing and advertising because they know the tax laws have changed and they're losing money because some companies don't want to spend money on entertainment because they don't get that deduction. So travel deductions, let's talk about travel. Travel could be a very important part of your business, depending on what type of business you have. So again, we want to look at, is it ordinary and necessary? So are business trips ordinary and necessary? What you can deduct are the hotels, the airfare, the 50% for meals in 2023, ground transportation. So, any ground, subways, Uber, taxis. If you want to go by the bicycle, someone pumping you on the bicycle, that's ground transportation and is deductible. Again, 2021 and 2022 allowed 100% restaurant and meals. And then 2023, we're back to the 50%. Now, one little trick that I inform my business clients of is that if you have your spouse that's an employee, then when you all go together for a business trip, you both get to take your airfare. You both get to get the meals. Also, if you are planning a meeting and if you have certain entities, S Corp, C Corp, you are required to have annual business meetings. You can have that annual business meeting anywhere in the US you want. International, you have different guidelines, but you could have that business meeting, annual meeting, anywhere you want, and you need to document. So a business trip is considered when you at least work 4 hours out of that day. So let's say you want to do a business meeting, your wife is an employee, and you have 2 other board members who just happen to be your friends, and you decide, let's go to Florida, and you live in Texas. You just need to have a meeting, say on Friday, you do a half-day meeting, and then you can do some team building and do other types of events. They're all deduction. Saturday and Sunday is a weekend. It's not a business day. You get to deduct still your hotel because you couldn't leave, because then on Monday you have a 4-hour continuation of that business meeting. So now you've turned that into a business meeting that is 4 days of deductions. So that's one way to look at how you can utilize travel deductions to benefit you as well. This also works if you're going to conferences. So you may have a conference on a Friday and then you plan a meeting with an associate or a vendor or a potential customer on that Monday. Well, then that Friday, that Saturday and Sunday, you're not going to fly back home just to come back. So it is a deduction as well, those expenses. Now, you just need to make sure on that Friday and Monday, you are doing the 4 hours of work. All right, travel deductions, renting from your family. So this is a little hack that you could also take advantage of. Remember, the tax code benefits business owners. So this is a tax deduction that I call renting from family, tax-free income for mom and dad. Let's give an example. It doesn't have to be your mom and dad. It can be anyone, but I'm just going to say mom and dad. Tax-free income could go to your brother, sister, or your best friend as well. To make this work, you need to have a business reason to stay overnight and to travel at the mom and dad hotel. So let's look at this example. Say you travel to a convention, rent your parents' guest room for 5 days and pay them $1,000. It has to be fair market rent. So how do you determine fair market rent? Go to Airbnb, see how much a house in that area would rent for during that time. They charged $1,000. That was fair market rent based on Airbnb or VRBO. You deduct the $1,000 as a business travel expense. So instead of staying in a hotel, you stayed with your parents. Your parents have tax-free income. The reason they have tax-free income is because if you rent a space for less than 14 days, you do not have to report that as income. So your parents have that $1,000 of tax-free income. Or your brother, sister, or your friend. So if your business travel takes you to where friends or family live and you would stay for them for free, change your tactics, rent their guest room. You deduct it as a business travel lodging and your friends receive the rent as tax-free federal income. It's so simple. Now, state and occupancy tax rules must be considered because some states have different rules. So I'm talking about federal. Remember, all of these deductions I'm talking about are federal deductions because each state has its own rules. Remember, there are 3 easy rules. You use the property as a home for more than 14 days a year. So the person, it can't be like a vacation home and they don't even use it. That person that you're renting from must use the home for more than 14 days a year. So it's an owner resident home. You have to charge fair market value. So whoever you're renting from, they're charging fair market value for that. And then number 3, rent for fewer than 15 days. Because if you rent for more, if you rent for 15 days, then it's going to be taxable. The person would report that on their taxes as income on a Schedule E. And then they would also be able then to deduct expenses. So it may still work for them when you talk about people renting rooms for Airbnb. That's what's happening. They are still deducting expenses, even though they have to report the income. All right, so that was ordinary and necessary. That was business deductions. I just gave you a free, a few little business deductions that you can take, but there are so many deductions between state and federal. There's probably about 1,900 strategies that I put in place for my clients. So just remember, work with someone that knows strategies, knows your industry, and knows how to maximize the code for your wealth. So we're going to switch to 1099s. And do I need to send a tax document to workers? With the 2023 filing season approaching, you must file 1099s NEC to workers by January 31st, 2023. And when I mean workers, those are independent contractors. So people that you're hired that are not employees. You must file as an employer by January 31st, 2023. There is a place called Tax 1099. It's a website that you can file these. and they will file the information to the IRS, as well as they will even mail or either email your workers, the 1099 contractors, these forms. You just need to make sure your bookkeeping is accurate and that you have taken in effect all of the work that you have paid to these employees. You're not going to put on this form any reimbursements that you sent to them. It's only going to be related to the work. So that is due January 31st, 2023. So do you need to send documents to workers? Also, W-2s. Most people know W-2s are due. So you need to make sure if you have employees, you are sending these timely. There is a penalty related to not filing your W-2s. And there's a W-3 transmittal copy that goes on top. If you're not using payroll services, you have to do this yourself. A lot of payroll services will offer this service either extra as part of your package, but make sure you're filing. I know I use ADP, and when I use that company, I still have to file my own 1099. So although I pay people through the ADP, the 1099 must be mailed by me and the 1096 to the IRS. So make sure you're researching and you know your obligations on what you still need to mail or file, although you may have a payroll service. Let's talk about the 1099 non-employee compensation form. So it used to be called 1099 MIS and it changed to 1099 NEC. So make sure you are filing the right form. They changed that, I believe, 2 years ago. You need to file a 1099 NEC non-employee compensation. Any person that is not a corporation and you've paid them $600 or more, you are required to send them a 1099 NEC. Now, if you paid them through a credit card, the credit card company is taking into effect what they've paid them, and they're responsible for reporting it. So do not include in this number any payments by credit card, because the credit card processing companies are required to send that information to the recipient. Some of the guidelines that you must consider: if you made payments to someone who isn't your employee, you made a payment for services in the course of your trade or business, and you made a payment to an individual, partnership, estate, in some cases a corporation. So you just need to know those guidelines. And you made payments to a recipient of at least $600 during the year. But remember, don't include those credit card payments. Even they start reporting the PayPal and the Square payments as well. Those companies, they're considered like a processing. You don't need to report if you paid them through that way as well. There are also other tax forms that are due by January 31st, and your business may have to file this form. Now, these are still called 1099 miscellaneous. So did you know that if you paid rent to a company that maybe you have your office in, you're supposed to send them a 1099 miscellaneous, and there's a box for rent. Certain medical expenses. If you send someone a prize or award, say one of your employees, you have a game and they win a prize, or in your business, you have a prize or award, you're supposed to send that person a 1099 miscellaneous. Certain attorney services, a 1099 miscellaneous, and then there are other ones that are 1099 miscellaneous. So you may be used to receiving the 1099 miscellaneous for certain things, or 1099 NEC, but make sure you understand your responsibility for sending these out. There is a penalty when you don't do it timely, or if you don't do it at all. All right. Let's see. So it's 12:31. So we're getting to how can you qualify for $26,000 per employee from the IRS. This is just money sitting there, and only 40% of people have applied. So what happened with this $26,000? It is called an employee retention credit. At one time, the IRS said that you could either get the PPP, which is the payroll protection loan that people got, and then they were able to get it forgiven if they applied for forgiveness and they met the qualifications, or the employee retention credit. So a lot of misunderstanding occurred because when they decided, the IRS decided you could get both, a lot of people were confused. It was very confusing during the whole COVID pandemic about, you know, the loans you could get, the SBAs and the forgiveness. And a lot of people were confused and just really frightened to apply because it wasn't clear that it was either was a loan or if it was something that would be forgiven or something you didn't have to pay back. But I want to tell you now that the employee retention credit, it is not a loan. It is money the IRS is paying on your behalf. Now, what happens is it is for you to retain your employees during 2020 and 2021. So it was to help small businesses retain employees during that time because it was very difficult for a lot of businesses. So the IRS wanted to give incentives and credits for that. So that was the whole purpose of that. And the reason that some people qualify and some don't, you had to meet certain rules. One of them is your business must have been required to shut down or it was restricted from operations. And that law could have been instituted by your city, your county, or your state. So if you had any of those lockdown restrictions, even if it was for 2 weeks, you may qualify. The US government recognized this and they wanted to provide an incentive to continue to keep employees on payroll. So that's what it was all about. Remember, the business is what the IRS wants to help. They want to help business owners strive and survive, and they were giving incentives. So do you qualify for the $26,000 per employee from the IRS? So we're 3 years in from when COVID first took place, and some businesses are still struggling to recover from the pandemic and could really utilize this tax credit to help the business stay afloat. So let's see if it's something that you would benefit from. So how do you qualify? To qualify, you could be in the private sector or you could have a tax exempt organization. So if you had those in 2020 or 2021, that's the first qualification. The second is, did you have a full or partial shutdown of operations because of government limit on commerce? So I'm in Texas and we shut down for maybe 2 weeks where certain operations that weren't essential had to shut down. So if that was your case in your city, county, or state, and there was some kind of governmental ordinance that says you have to do that, you may qualify. Now, this can't be because you thought you wanted to shut down and you didn't have employees. That may not be a reason. That could be a reason under a different qualification, but under this partial or full shutdown, it has to be something that's governmental order. The second test that you want to look for, and it's either or. So if you satisfy number one, then you may get a partial. But then if you go to number two and you have a certain percentage of your gross receipts declined when you compare to the same quarter. So let's look at March. I think that's when a lot of the shutdown issues were getting required. Let's look at April. So in April, if you made $100,000 in April of 2020, but then in April 2019, you made $300,000. Then a certain percentage of your gross receipts has declined, and you may be eligible for the ERTC credit. Also, if you have a recovery startup business, so you started your business after February 15, 2020, so after COVID was well on the way, and you made under 1 million, then you may still qualify for an employee retention credit, but you would be capped at $50,000 total instead of $26,000 per employee. But there's still an opportunity for you. So that's the general overview. Now let's talk about specifics. There's also certain rules around the size of the business. So you have to have a business that's 500 or fewer employees. If you have more than 500 employees, you don't qualify. If you have 100 employees or less, you can apply the credit regarding if your business was operating or not. So that means if you had to shut down your business and it wasn't operating and you weren't paying the employees, you still may qualify for this employee retention credit. If you have more than 100 employees, but less than 500, you can only qualify based on wages you pay to employees while the business was shut down. So say, for instance, you shut down your business, but you wouldn't pay anybody because you weren't getting any business and you weren't paying anyone, and you have more than 100 but less than 500, you're not going to qualify. So you would have to provide services and be in operations if you have more than 100 people. But small businesses under 100 employees, you can apply even if your business wasn't operating. For 2020, there are different rules for 2020 and 2021. So let's go over 2020. Employers must have experienced a government shutdown or a significant decline in revenue. So I talked about the overview that it was a percentage. Well, in 2020, it's a 50% decline. So that means in that example I gave, if you made 300 in 2019, if your business in 2020 over the same period was 150, that's a 50% decline and you may qualify. For a significant decline in revenue, employees are eligible for the first quarter in which they experienced that decline. So if that happened in the first quarter of March, then you would be eligible in that first quarter. How it works is you get to pay each employee $5,000 in 2020, but it's 50% of their pay. So that means that person would have had to make $10,000 and you are eligible for 50% of that. The max is $5,000. If you paid them $20,000, you're still maxed at $5,000. So just remember that. Also, if you have a significant decline and it continues the quarter after the first in which you exceed that 80% of revenue, you continue to qualify each quarter. So say, for instance, you had somebody in the first quarter you qualified, that was an employee, and you've used up their $5,000. And then you hire someone in the third quarter and you're still in the decline of your revenue. Well, now you can pick up that person as well. And if you paid them $10,000, you can get the $5,000. If you paid them $8,000, you would get 50% of that, of $4,000 for that employee. So let's look at the flow chart on if you qualify. Did the business experience a government mandated shutdown? Yes. Okay, you may qualify. No. If no, then you want to look at this other test. We talked about revenue. Did the business experience a decline of at least 50% in the quarter of 2020, any quarter of 2020 compared to 2019? If you say yes, then you may qualify. If no, then you don't qualify. So this is a good overview chart for 2020 just to see if possibly you could qualify. Then the next step, if you do qualify, is to look at how many employees you had that were not you or your family members. So unfortunately, the IRS didn't allow us to get a credit on our own efforts and salary. So it can't be your salary, your wages, or your family members' wages. But if you did have other employees, you need to look into applying for the employee retention credit if you are in the field where it says may qualify. The overview for 2021. So there was a change. Instead of having a 50% decline in your revenue, the IRS changed it to 20. So that means that your revenue didn't have to decline that much. They realized by 2021, some companies were recovering, but they still wanted to be able to incentivize companies that still needed assistance with hiring. So instead of having your revenue decline 50, they said, oh, if your revenue declines 20, you qualify in 2021. Also, if you started the business and it was formed after February 15, 2020, you may qualify. So this is really good that they did this, because I know a lot of businesses, 2020 was horrible, but then they really started ramping up and they were increasing in their revenue, but they hadn't made it back to the 100%, but they were still over the 50. So now your revenue just had to decline by 20%. A significant decline is considered to continue until the quarter after the first quarter. So what happens in 2021 is for every quarter, you can get $7,000 per employee per quarter. And that's quarters 1, 2, and 3 of 2021. So that's how we come up with the 26,000. 2020, it's a 5,000 cap per year for the employees. So they would have to make $10,000 over the year and you get half. In 2021, it's a per quarter amount. So if you pay them $10,000, the IRS says you can get 70% of their wages in ERTC. So now you have 7,000 in first quarter 2021, 7,000 in second quarter 2021, and 7,000 in third quarter 2021. That's 21,000 in 2021 and 5,000 in 2020 that you could be eligible for. Awesome. Don't miss this opportunity to get assistance because you were loyal to your employees and you paid them, or you wanted to but could not because of your operations weren't in existence. You may have brought them back later, but you are still eligible for this credit. So beginning in 2021, that's the qualified recovery startup. You must have started your business after February 15th. Your annual gross receipts have to be $1 million or less, okay? And your credit amount is limited to $50,000 per quarter, regardless of the employees. So that is something that you can still get a $50,000 credit. Your business would have had to start after 2020 and then be less than $1 million. Let's look at the flow chart for 2021. Again, we just look at the business experience a government mandate. Yes, you may qualify. If you say no, then you have to look at your gross receipts test. Did you go down 20%? Yes, so you may qualify. No, if the business qualified recovery startup. So this may not apply, and that's because you're just starting your business. You started a recovery business, yes, then you may qualify. So these are the opportunities to qualify. So who's eligible for the eligible employer? So most majority owners cannot claim their wages. So I talked about that. And wages paid to persons who are more than 50% owners of owners' relatives do not count as eligible employees, but your other employees do if they're not in that category. The credit is fully refundable, meaning that even if the credit is greater than the amount you would have owed in taxes, you will get money back. So remember that this credit, you can apply for it by adjusting your 941s, and that's a tax form. You adjust your 941s with the 941X. So even though you may not have paid that much in, you're going to get this credit, and it's real money. It's taking about 3 months to get the money from when you apply. So the deadline for 2020 to apply is April 15th, 2024. So you have over a year to file. And for 2021, you have until 2025 of April to file these claims. So please look into it. So to check your eligibility for ERC, I have a website that you can go to, and it's down below, https and then CatrinaCraft.com/ERC. If you go there, there will be a quiz and you can go through the criteria. And then I will say if you pre-qualify. So this is a pre-qualification, and you will be able to enter if you want additional information or if you want to really look at your numbers to see if you do qualify. And you can set up a consultation call there. So tax strategies, we talked about, is it deductible? And I gave you some strategies, and I have more to give you, but I gave you some strategies on what you can take as a business. We do provide full consultation. We do a customized tax plan, and then we help you implement that plan. So just like I told you, you need the meetings every year. We're going to help you create the meeting minutes, because you have to have minutes to support that you did have the meeting. Or if you want to hire your children, you have to have a job description. You have to track their wages. You have to track their time. So there are certain things that you need to follow and implement, and you want to make sure it's under the IRS guidelines. Our customized strategies are usually about 40 pages, and it lists the IRS code, because we want to make sure that you understand if you are ever audited, we're going to support you in that. If we prepare your tax returns, and we're going to say, yes, this is the code section that says that you can take this deduction. So Craft Money Map, it's a tax planning system that I have. It helps you really maximize the money. Keep money in your pocket instead of paying to the IRS. It's allowing you to plan for retirement and really leave an estate for generations. You want to make sure you're protecting your assets and you have the right entity structure. Some people may not be in the right structure. So we talk about that. You know, should you be a LLC taxed as an S Corp, a partnership, or a corporation? Did you know that the LLC is not a recognized entity for the IRS? So you have to be one of these other entity structures, but a lot of attorneys are not informing clients of what that means. So you really need a tax advisor to help you navigate those situations. And we help you figure out what is legally deductible for your business and your life. If you are interested in learning more about the customized tax plan, you can go to catrinamcraft.com/wealth. And there will be more information about that, and you can fill out the information. We will see what fits you best, because we have different plans. Most of the plans for a strategy would be for business owners that have been in business and 2 or 3 years and have a certain level of income. But we have other resources. If you're not there yet, if you're just starting your business, we have resources for you as well. So please make sure to visit that site. And our process is really just, we discover where you want to go, because we need to know your goals. We're not going to push something on you that you're not comfortable with. Then we're going to strategize. How do we get there? We want to execute and implement getting you there. And then we're going to review. Did you arrive at where you thought? If not, we need to calibrate. I mean, sometimes you get on a journey and you get on the road and you decide, okay, that was nice, but now I'm pivoting to something else. So we know that it's always moving, and you may need to adjust where you're going. So that's our system. I hope that, I know this is a lot of information. I hope that you gain some great insight. It just opens your mind to the possibilities of what you can do for employee retention credit. There's money right there. You know, don't be afraid to investigate and to apply, because the IRS wants to incentivize business owners to continue to have the economy grow. You can reach me also at catrinamcraft.com, and you can sign up. I do weekly newsletters and tax tips, and I'm on Instagram, YouTube, and Facebook under Catrina M. Craft. So I hope that if you have any questions, you can submit those and I can answer a few questions, but continue to ask the questions, because we're going to have a database of the different questions and we'll answer them, and we'll probably put them on the website or send them out. And also fill out under catrinamcraft.com. I have a special gift that I'm going to send everyone about some other tax deductions that I did not mention that you're going to want to get. So thank you for inviting me, U.S. Black Chamber, in conjunction with the SBA. I appreciate this opportunity.
Catrina, That presentation was fire, and so is this chat with questions. I want to take the next 5
Okay.
minutes and hit as many questions as we can. We give thanks to our listeners in participation. First question, and Catrina, if you've already hit on this, repetition is always great, right?
Okay.
Are sign-on bonuses deductible?
Deductible by the business? Yes.
Okay.
So I'm not sure if they're talking about from the business owner's perspective, but yes, if a business owner pays a sign-on bonus, it's still wages. It needs to be under the employee's wages on their W-2, and it is a deduction.
Okay.
If they're talking about for themselves, like they are an employee and they work for someone, then you pay taxes on that.
On that bonus. Okay,
Yes.
thank you for answering that on both ends. If you have an LLC and you gave yourself a CEO distribution, do you need to issue yourself a 1099-C?
You do not need to issue yourself a 1099 NEC. So that's for other workers. A distribution, a LLC as a distribution, if you are an S Corp, so it's different ways. If you are an S Corp, I'm not sure if you're S Corp. If you're an S Corp, then any earnings that you make will be on a K1. So the bottom end profit would be on a K1, and that flows to your personal tax return through a K1. If you're a sole proprietor LLC, you do not have to issue yourself a 1099 because you're going to be taxed on the net profit of your business on your tax return, and you're going to have to pay Social Security taxes on that. So do not issue yourself that statement.
Okay, we have time to ask one more question. There's so many, and as Ms. Craft said, we have jotted all of these questions down, and we will be sending them out to all the registrants of this webinar with answers. Should a 1099 and a 1099 miscellaneous be filed jointly or separately?
Separately. So a 1099 NEC is for the non-employee compensation. And that 1099 NEC, there's a summary form that you have to file with the IRS. If you go to that tax1099.com website, it is so simple. I love it because you just put in the employees, all of their contractors information, not employees, but the contractors information. You actually can do W-2s on there too. So you can do employees, you can do W-2s, 1099s, NECs, and then the 1099 miscellaneous is a whole different form. And if you go through that process, or if you go to Office Depot, Staples, or order these forms online, you can also do them manually and order those forms online, but they are very different forms and they need to be filed separately to the IRS.
Catrina, thank you. Thank you so much. Thank you everyone for attending. We're going to throw up a slide really quick and let you know more webinars that are on the way. Catrina, I cannot wait to invite you back in another, maybe March, we'll see you.
Yeah.
If that sounds great with you.
Yes.
We know USBC is more than excited to be working with you moving forward. Thank you all for attending the 2022 Tax Season Preparation Tips webinar. This was possible through our work with the SBA Community Navigator Pilot Program, funded in part through a grant with the U.S. Small Business Administration. A tremendous thank you to you, Catrina Craft, CPA and financial advisor. And thank you to our community navigator chambers for advocating for Black business, and to you, our viewers, for sharing in the discussion. USBC introduced by Black, the only Black certification program with a business directory, providing businesses that certify access to private and public procurement opportunities, highlights, and other benefits. This online program can help prepare you for the contracting space as documents preparation guide. Certify today by visiting usblackchambers.org/certification. We invite you to give us your feedback on today's session. Just scan the QR code or type in www.surveymonkey.com/r/bizfuture. Join us for upcoming events by visiting usblackchambers.org/webinars. To register for topics such as February 2nd, Business, it's more than LLCs, and that will be 10:30 East Coast time. Second webinar we want to go ahead and introduce to you, the live webinar by Black.us, platform for Black-owned businesses. That'll be February 8th at 5 p.m. East Coast time. And finally, retirement plan options for small businesses, February 9th at 11 a.m. East Coast time. We will be coming to you with webinars all year. And Catrina, thank you for joining us today. To our viewers, thank you for joining us in discussion, and we will see you very, very soon.